Okay, so good morning, everyone. Welcome to today's macro snapshot. Where are we? It's the month end today, so maybe some flows, US dollar buying or selling. Friday, February the 28th of 2025. Okay, so obviously yesterday we had we had a pretty nasty sort of sell-off in the equities, strength in the US dollar. So let's see what was going on. Trump, obviously, I think there were kind of two catalysts. There was a broader picture of the data coming in. So if we actually look yesterday and see what happened. Hold on, let me just put this up to yesterday. We had the initial jobless claims coming in, which in themselves is just a weekly number. And let's have a look here. If we look at the initial jobless claims, it went up to 242,000, which is the most it's been for, I think, a couple of years, or at least as like 12 months or so. So in the recent period. And this is just feeding into this narrative that Trump is firing everyone, Doge is firing everyone. The government workers in the hundreds of thousands will be losing their job. The real economy is softening, et cetera, et cetera. But I think we have to sort of calm down a little bit because I actually looked at some sort of analysis of those numbers, and there wasn't a huge amount of stuff in the Washington, D.C. area. There's no specific evidence that these numbers yesterday of 242,000 weekly claims was, a bunch of sort of government workers who had been fired. Now, could that be the case in another 2 or 3, 4 weeks? Yes, absolutely. But at this point, the market is very much focused on narratives, as it always is, and the narrative is that the real economy is potentially weakening. And when we saw this number, that did sort of upset the market a little bit. Also, the fact that, for example, you see here the core PCE price index went up to 2.7, and that the GDP price index went up a little bit. So a little bit of this narrative of sort of a stagflationary environment where inflation remains sticky and the real economy is potentially starting to weaken. But the reality is that if you look at for example some of the durable goods numbers, they weren't horrible in any shape or form. The headline expected at 2 is at 3.1%. Ex transport down a couple of tenths, but then you look at non-defense excluding aircraft, actually higher than expectations and higher than last time. So the point is that I think the real economy is actually doing fine, but the narrative is that the party's over. And why is that? Is because Trump also came in the very big thing yesterday and seemed to confirm that tariffs would be being placed on Mexico and Canada this coming Tuesday. I think it's March the 4th. We still don't have that date, so let's just see if there's room for negotiation. But for sure, Canada and Mexico under pressure there, and also China. He had an additional 10% of tariffs added to the initial 10% of tariffs on China. So it looks as though that's heating up. So the big narrative here seems to be that Trump definitely does want some form of tariffs. He does like tariffs in some form, whether that's just a negotiating tactic, a carrot and stick, and he uses the stick first and then gives the carrot just in order to sort of sweeten some of the trade terms with other countries. We'll have to see. But it does definitely seem as though they are trying to get growth down a little bit, maybe unemployment up a little bit. And it's not that they necessarily want that, the Trump administration, but they do seem pretty obsessed about getting the 10-year yield down and getting inflation down. And I think possibly the narrative is, I'm not sure saying it's exactly the situation, but the narrative in the market is that Trump might be prepared to see a little bit of short-term weakness in the stock market and a little bit of a spike in employment, especially of those wasteful government workers, just in order to bring growth down, which will bring down the 10-year yield, which will bring down inflation. And then the idea is that tariffs would kick in, more industry and manufacturing and building would happen back in the US, and within 6 to 12 months, the economy would sort of boom again. And so Trump is trying to do this stuff very, very quickly. He's only been in power for a month. There's 4 years, of course, and for at least from the commentary I'm sort of reading and hearing, it's that there seems to be within the cabinet this idea that if we sort of get all the nasty stuff out of the way for the first 3, 6, 9 months, later on in Trump's term, the economy will have rebounded and will be booming. That's maybe the theory. We're going to get a little bit more information today just on the economy. Today, as I say, is Friday the 28th. So here we've got some core PCE numbers. Nothing crazy as expected. But if you actually look at the month-over-month number, expected at 0.3, which is the same as last time. So that really shouldn't shock the market. 0.4, of course, would be unwelcomed. We also have the price index here, and we have some real personal spending, and personal income. That's going to be interesting in my view, just to see, give us a bit more information about the US consumer. Is the US consumer really hurting or not? So let's just keep an eye on these numbers at 8:30. And as I say, the market at the moment, especially after yesterday's equity sell-off, is extremely sensitive to any signs that the real economy or the consumer is weakening. We shall see. Okay, so just getting back to some of the markets. Obviously, there were a few different markets which were hit. So if we go and look at, let's start with the currencies, because quite a lot of action in the currency markets. And of course, in that news, that potentially there could be sort of tariffs being confirmed of 25% on Canada. USD Canada CAD basically spiked. You can see here getting getting back into this sort of range. What's going to be interesting here is that if these are confirmed on Tuesday, and again we don't have a confirmation, I could see USD CAD hitting up to maybe 145 up here, something like that, just sort of breaking a couple of these levels. This, of course, is when there was the idea that tariffs would be happening, but they were sort of not imposed, and there was a waiver for a month. So I think in the short term, if the tariffs do come up, we have a 145. And then if they're confirmed and we get more detail and they look nasty, I mean, there's no reason why we can't test up to 147, 148 as well. So that's going to be interesting. Just in terms of what's happening in Canada, we also have Canadian GDP this morning at 8:30. Let's keep an eye on that just to see if Canada is sort of stabilizing, or whether some of this fear of tariffs is causing businesses to not do investments and to put off decisions, and that's causing maybe some GDP. But it is backward looking. It is for the fourth quarter of 2024. So I don't know how much the market will look into that. The other interesting thing is just politically in Canada, there will be an election coming up in a few months. And it's interesting that the outgoing Prime Minister Justin Trudeau of the Liberals, who's been in power for 10 years or so, you can see here that this is the Liberal Party. This is opinion poll. So the Liberal Party, which is sort of a left of centre party, was down here in the red, trailing much below the Conservatives. You see here in the blue. So if you go back all the way to 2023, 2024, you see that the Conservatives definitely were favored to win this election. Pierre Poilievre, who at sometimes has allied himself or aligned himself a bit more with the Trump rhetoric. And what's interesting is that since this threat of tariffs and Trump calling Canada, the 51st state, and Trudeau is just the governor of the 51st state, the Liberal Party, in the form of Trudeau and Doug Ford, one of the local premiers in Ontario, they fought back quite strongly. And it's interesting that Doug Ford actually just won his election yesterday for Ontario, Canada's biggest province. And so basically what's interesting, you can see here, the point is that in the opinion polls, you see here how the Liberals in the red here have actually joined now up with the Conservatives. So the point is that Pierre Poilievre of the Conservatives, which is a bit more of a center-right kind of party, a little bit more sort of free market, pro-business. But interestingly enough, it doesn't look any longer as though they are an absolute favorite to win the election. So that's definitely causing, that's going to be interesting. And you'd have to say, and it's a curious one just in terms of the USD CAD, the Canadian dollar, because ordinarily one could argue that, were the Conservatives to win, in theory, that could mean less regulation, more pro-business, more free trade, less government spending, smaller deficits in theory, which potentially could be a positive for the US, for the Canadian dollar. But if it looks as though the Liberals might win, and it's seeming as though the new leader replacing Trudeau will be ex-Bank of Canada and Bank of England Governor Mark Carney, maybe that's not the case. So interesting one just to look here at the internal politics of Canada. The other currency, of course, I'm not going to talk about the Mexican peso because we don't trade it that much, but it's actually hanging in there reasonably well. It's actually the Chinese renminbi. And if we look at the CNH, USD CNH, you can see that yesterday had a big pop up. Subsequently overnight just come down a little bit. But we have next week, we have Trump on Tuesday, which is tariff day. addressing the joint session of Congress. So it'd be interesting if he sort of lays out more sort of talk about tariffs and sort of geopolitical stuff. But probably more importantly, over in China, we have the big meeting of the Communist Party. What do they call it? The two sessions, and that's often when sort of forward goals in terms of the economy are announced. And it's interesting timing that if those tariffs of 20%, 10% plus 10% are confirmed on China, if we do start to get some kind of more aggressive reaction on China, and indeed in terms of their fixing, will they let the renminbi weaken a little bit just to try and start offsetting some of the tariff effects? Now, if we actually look at the renminbi here, we can see that going back to, let's say, the beginning of October, it actually has weakened pretty substantially against the US dollar. At this point, where anything from about, let's say, call it 4.5% to 5% or so. So it definitely has weakened already, and maybe that was in anticipation of Trump and tariffs, or maybe it's just coincidence. But what is going to be interesting is just to see whether just slowly to offset the effect of tariffs, the Chinese authorities do let the yuan weaken up to, and it looks as though this level is maybe a first potential target, 7.36. That's a triple top. It's been rejected three times, and we've seen here three times that the Chinese authorities, the PBOC, have actually stepped in to not keep it too weak, because of course they are also hoping that the Chinese renminbi will at one point become one of the world's important reserve currencies, and they want it to remain stable and not to weaken too much. But I do think, though, if the Trump tariffs are imposed, we could quickly see that heading up towards there, at least as a kind of a first step. Just going to grab some tea here. I have Earl Grey this morning with a touch of bergamot, giving it a nice citrus undertone. Anywho, let's continue. So obviously, of course, what people now looking at is the euro. So if we look at the euro US dollar here, we don't specifically have any tariffs announced as yet. Trump last week or a few days ago, he did mention, sort of the auto industry, chips, other things. So there's definite nervousness. This level here, as we've signaled, 105.30 is absolutely key. There's been three times rejected. Yesterday, of course, going down just on this threat of tariffs. We have the ECB probably cutting next Thursday. It's the following meeting, which is only 66% priced in at the moment for a cut. We don't know what's going to happen there. It's interesting. We'll talk about that a little bit next week. But definitely the euro, you'd have to say, under pressure. And I do believe that it's going to be difficult for the euro to get higher than this 105.30. If it gets up there, I think that'd be an interesting shorting opportunity again. Now, can it get down to 102 and even to test down to parity at 1? Yes, but I think that will quite possibly require some more specific information about tariffs, which is to say the imposition of tariffs. If we get tariffs imposed on Europe, for sure, this euro USD will get down to 101.80 in a day or two, and then maybe break that and head down towards parity. So definitely the euro sort of under pressure at this point. The other thing as well, just looking at the Japanese yen. Interesting. Well, let's just look at the dollar index, which of course is 58% euro. The dollar having a nice bounce yesterday. Now, is this going to turn out to be some kind of bull flag here that was just taking a pause? You see here down to the 38% fib retracement from this big impulse. Looks like it at this point. Let's see if it breaks out the dollar. But what is interesting is that's the dollar index. But if we look at it on the Japanese yen, also breaking out a little bit against the yen, being supported, as I was talking about yesterday, just in this sort of little sort of consolidation period here at the as horizontal support, but also the 50-day, 50% Fibonacci retracement here from this big impulse going all the way back to the 12th of September. So it looks as though the US dollar is heading up towards the Japanese yen, but the Japanese yen against all other cross pairs, things like, for example, I don't know, CAD, it's already come a long way, but let's say, for example, the Canadian, we see CAD up a little bit today against the yen. But I do believe that, if the tariffs are to be confirmed on Canada and Japan, we had the Tokyo CPI last night, which was, wasn't too hot. But the BOJ does actually hike another time or a second time, so twice potentially in 2025. And Japan seems to be escaping the wrath of Trump in terms of tariffs. I do believe that here that CAD JPY can break, and they would have to go back down here to historic levels. As you can see, there is some more downside historically, even going back to 2023. You've got, potentially you've got like 2.5%, and then even all the way down another 6 or even 7%. So yes, CAD has fallen against the Japanese yen. It's in this kind of trading box here, but if it breaks this box here, it definitely has another 3 or 4% downside in theory. I also think that the Australian dollar, if you look at the Australian dollar versus the US dollar, that's under a lot of pressure, especially as it relates as a proxy with the situation in China tariffs. The Australian dollar does not like in general, doesn't like threats to global free trade, but specifically doesn't like threats of the US and China involved in a trade war, which is going to have sort of spillover effects for the Aussie dollar. So you can see here the Aussie dollar last couple of days, especially yesterday, being absolutely whacked by the American dollar. And any negative news on China tariffs is going to cause that further pain. And again, something like the cross pair, if we look at Aussie, the Australian dollar versus the Japanese yen, similar situation to CAD, JPY, kind of been in a trade range, trading heavy, trading weak. And for sure, this is not an attractive level to be selling. But if we get some kind of bounce here and the tariffs on China are confirmed, and more broadly, seems to be sort of more tariffs happening globally, any rally here, I mean, ideally up to 96.8, something like that would be wonderful. But, the Aussie dollar, can it go down more against the Japanese yen? Again, look at the longer term chart. You see that on the downside, there is still, at least just to this recent low here, which was the yen carry trade unwind back in July, there's still 3%, and even further down another maybe 2 or 3%, so maybe 3, 4, 5%. So those cross pairs, any sort of rally in the Japanese yen against some of those cross pairs like the euro or CAD or the Aussie, I think it's an interesting shorting opportunity in theory. Okay, guys, another interesting thing to look at is gold. So gold yesterday sold off. And one of the big questions here is like, okay, well, we all love gold. We know it's being supported. When would be a place to buy it? But as you see, it keeps on being sold off. And it's interesting. Yesterday, when we had yields coming down, we had a very big sell-off in the equities. One would have imagined that gold as a safe haven would have been a risk-off kind of buy. But it looks as though, just from what I'm seeing and observing and what I'm reading, is that it's a bit of deleveraging. A lot of funds with a higher volatility just sort of, their VAR, the value at risk, just reduced everything and deleveraged. And gold was probably sold a little bit. So I think gold, excuse me, we know definitely there's a lot of sort of central bank and a demand for that. We also know that in emerging nations, China, Turkey, Brazil, these countries, a lot of people there that retail loves to buy gold. Personally, I'm looking at this level here about 2790-ish. This is the cash market here, well, the spot market, 2790. There's nice horizontal support. It sort of represents, depending on which chart, sort of between a 38 and 50% fib retracement here. And if we actually look at the moving average, that's a simple moving average. Let's look at an EMA. You see there's around about the 50 EMA here, so I think that's a pretty interesting level there. I think gold there as a risk reward, again, it has to fall, another few percent, but I think around about 2780, 2800 is a pretty interesting level for gold. Okay, so let's move on. Obviously, interesting. Well, I don't want to say obvious, nothing's obvious, but VIX up. You can see here VIX up. And if we actually just look on the curve, which I do like to look at, if I can find it here and bring it up, let's have a look on the curve. Actually, I don't think I have it up here. So just give me a second here. I'm just going to bring up the VIX curve. But the point is, it's still in a backwardated kind of state. So I'm just going to, so here's the VIX futures curve. Okay, so this is the live price. And again, as you can see, spot here well above the first futures contract and going out to the first, second, third, fourth futures contract, well above those. So that's still not great and still indicating quite a lot of risk in the market. This is yesterday's price from the 27th. So you see that was there. And if we go back, let's say a week or so, which is the orange kind of guy. You see here that not only is the actual VIX price, but again, the curve much, much lower, sort of in contango below the futures curve here. So we see it's sort of flipped into a backwardation and is staying up there. So the point is that the VIX is, trading, anywhere 18, 19, 20 kind of handle. And if we just have a look now on the trading view chart here, you see it's trading at 21.10. So high implied volatility at the moment. Which brings us on to equities. Now, obviously, we've had a pretty big sell-off at this point. We've had, what is it? I think it's about 4.5 to 5% sell-off. Yeah, 4.6 on the cash on the SPX. Interesting here, it filled this little gap. It went straight through that. It's gone through. This is the 100 EMA here. There's the 200 EMA. Personally, I think what's very, very interesting here, which I've mentioned a few times earlier this week, is this Trump gap. This is the election here from the Tuesday night, the election, and that's the Wednesday morning, the next trading day. I personally think what the market was definitely finding it very difficult to have new momentum to push much, much higher. Any high was only by a few points, and it was being rejected. We've had now 6 consecutive selling days, which historically is quite a lot. Doesn't surprise me at all if there's a little bounce. I'm probably getting a little bounce. Yep. So you see here on the futures, which is obviously open already, has been open since 6 p.m. We're getting a little bit of a bounce. I think really what we need to do here is pretty simply got this reverse fib here. So this is from this impulse down. Let's just be very clear here, guys, and I'm going to put it on a 4-hour chart here. This bounce represents nothing. I mean, in order for this to have any sort of recovery or bullishness, we would need to see some kind of pretty quick V-shaped bounce, or at the very minimum from this. Let me just make that a bit more precise. Let's say using the fibs here, it's a pretty easy way to look at it. We haven't even got to a 38% retrace. So the minimum would have to get up to 59.80 on the futures. I'd prefer even the 50% at 6,017. And I think we're not actually saying, oh, we kind of shook that off definitively, unless we get above, let's say, 6,050, 6,053. We really need to be up here. Anything less than that is simply a reactive bounce, people getting out of their positions and, sort of selling. Now, it's not to say it can't bounce. It's the last day of the month. It could be flows. But just to say here, and again, I'm going to put it back on the cash market, I do believe that the market wants to send a message to the Trump administration saying, hey, do you really want to go forth with these sort of anti-growth policies? Do you really want to keep on trying to fire people willy-nilly? Do you really want to kind of, sort of complicate and maybe even weaken the global trading system through the imposition of tariffs on allies such as Canada and, Australia and, obviously Europe and especially China, which is not an ally, of course. But, so it's kind of interesting here because this is the Trump gap. Very, very interesting to me today to see whether we push down or whether we just have a nice little sort of maybe a non-day or a little sort of bounce. If it pushes down here, you've got to say, and I'm looking at the NASDAQ here. If we look at the NASDAQ cash index, I'm going to put it on the 200-day simple moving average. That's interesting on NASDAQ, on the cash index, using that as a reference. As you guys can see, if we go back to quite a long way, this is the big fat sort of fuchsia colored line here. You can see here the 200-day average has basically held for the whole time. That's a very key level. So that level there is about, 20,190 on the cash index. Because if we break through this, the Trump election, the November election levels, and you can see here on the NASDAQ that we're right there as well. So pretty important day today to see whether it wants to go and try that the equities in the US want to go and fill this gap. If it does that, I think the next stop's going to be the 200-day simple moving average. Absolutely key. At that point, we will have sold off for 6 or 7 days consecutively, which is a lot. Yeah. So the question is, what happens now? Can it have a bounce? I think yes, possibly, if you want to day trade that for 20, 30, 40, 50 ticks. But personally, I'm thinking here that the market feels that the real economy is being put under pressure, maybe unnecessarily by Trump, through the potential imposition of tariffs and certainly uncertainty. Uncertainty is leading businesses to delay investment, which in itself is a negative. So I think the way to be looking at this, unless Trump suddenly comes out and shows clarity on tariffs, is maybe to be selling rallies, looking to be selling rallies is the idea. That's my personal view. If we look at the Russell, Very, very weak. The Russell has actually broken down under the 200-day simple moving average. So very, very weak price action. If we look at the Mag 7 index, we can see not only did it break out of this sort of sideways pennant, but it's broken the 100-day and it's well on its way. A pretty key level here on this ETF, the Mags, 49.68. Let's see if it holds there, but on its way down there. And I mean, the equal weight RSP also very weak here. Looks like it's trading down, out of the trade range here and potentially going to test the 200-day simple moving average. So the point is that equal weight underperforming, small caps underperforming, the Mag 7 not performing well. There's a broad sell-off going on here, a sort of a de-risking and a de-leveraging. And we even seen NVIDIA yesterday, which popped higher, sold off. Actually, just have a look at the NVIDIA chart very quickly here. Sold off a lot. Yeah, a big red candle, which reversed after. So interesting just in terms of options, because when we actually, how much did it actually end up going? Went up 8%, which is actually was relatively close to what the option market was pricing by the end of the day. I was pricing about 9 to 10%. So that's kind of interesting. Okay, guys, I might leave it there. Just on the bonds, sorry, just looking at global equity very, very quickly here. So we see that in the Euro stocks, there has been a bit of consolidation here in the Euro Stoxx 50. If we look over in Germany, we can see there's been a bit of consolidation, a little bit of a bounce. The market's still pretty fragile. If we look at global equity, if we look at the Nikkei over in Japan, a big sell-off day. It actually broke down below the trading range. And of course, having a strong yen doesn't help that. Strong yen, especially on the cross pairs, is not helping out, making those stocks expensive. Emerging markets, I imagine, is down quite substantially. Emerging markets also not enjoying this talk about tariffs on commodities and copper and just tariffs in general. What is benefiting, of course, we've got the bonds having a bit of a safe haven play. We've got the 2-year up a little bit. But again, what's kind of interesting, I'm not going to go into this too much, is just the shape of the curve here, because we see that something like the long end of the curve actually has done a little bit better. So the US market pricing in, maybe a slightly more dovish Fed, but is still concerned about inflation. So the pricing for the Fed is not moving too much. Really what we're seeing is that the long end of the curve, which really reflects the future path of growth and economic activity, those yields have come down a little bit more. So we have seen a little bit more flattening of the curve. Not a huge amount. Let's have a look. Just let's say like that's the 10s, 30s. Oh, here's the 2s, 30s here. Well, actually pretty stable, not a huge amount. So that's interesting. What actually I was thinking of, I was looking actually yesterday at the 3-month to the 10-year, which a lot of institutions look at. And the 3-month to the 10-year curve, the 3-month really is a proxy of like Fed funds, sort of money market rates, and the 10-year, of course, is longer term. And it's interesting that this actually inverted yesterday again. So it had gone positive up to about 40, 50 basis points, but as you guys can see here, it's now below zero. And so that's indicating potentially that the market is saying, hey, the Fed is not going to do too much, because we're still worried about inflation, as is still sticky, but the real economy is potentially, economic growth is potentially weakening. So this is almost a little, I don't want to use the word stagflationary, but the 3 months to the 10-year is giving us a sense of what the market is thinking, that inflation is sticky and the real economy is maybe sort of slowly weakening. Anyway, enough of me. Just to say, guys, just quickly as well, just wanted to look at oil. I won't bore you with that too much, but just a very weak bounce again. Look at that. Just one day, as I've been pointing out, any bounce has only been 1 or 2, 3 days. Again, bounced up one day, maybe tariffs on Canadian oil, but immediately sold. So at this point, you've got to say that oil potentially, if it breaks down through here, minimum probably wants to test the bottom of this trade range around the mid-60s. Let's call it 66.50, 66.60. I think down here, though, would be an interesting buy, although there's still plenty of spare production capacity out of OPEC. But still, oil is just very dead money just at the moment. Okay, I'll leave it there. Let's keep an eye on the end of the day. Also very interesting to see stocks. Of course, I've got the PCE and some data at 8:30. But just keep an eye on the cash indices for the NASDAQ, NDX, and the SPX, just to see whether that Trump election, which is Wednesday, I think it's the 5th of November, you'll see that gap, whether that starts to be filled in, which I think is the stock market trying to signal to Trump and just saying, hey, is there a Trump put? Does Trump care about the stock market? Or is he happy to let it go down with the bigger goals of reducing growth, reducing inflation, and getting his tariff jigsaw puzzle all sort of put into place? We'll get some answers by 4 p.m. today. Thank you, guys. Have a great day and have a great weekend. Thank you.